We are live on Fun Friday, episode 6, with a friend, a partner, and actually a stand-up comedian at one point in his life, the principal and founder of JKAM Investments, Jack Krupey. How are you today?
Doing great. Thank you for having me.
Absolutely. Well, it's a pleasure to have you on the show. Naturally, we like to work and connect with people that we like at Lone Star, people we want to do business with, people we want to do deals with. And Jack has been a partner on several of our deals. He's certainly someone who we love to get dinner with, connect with, maybe throw a drink back with, and everything in between. So it's really fun to have you on the show. We know each other pretty well. So excited to kind of talk with you here on this platform and kind of have you explain and tell your story about where you're living right now, why you're living there, and your experiences, because you've had a unique arc with regards to what you're doing and the GFC, the Great Financial Crisis. So without further ado, maybe give your introduction, maybe where you went to school, and then maybe start telling your story.
Sure. So I actually got started around the prior crisis, the 2001 .com crisis. So I was from New Jersey, but went to college upstate in Rochester, New York, and was really into the internet. It was early days of Prodigy and America Online, and was fascinated with the technology and the internet. So I went to school for that, but graduated during the .com crisis. So I had a job, but it wasn't the same opportunity I expected to have a few years earlier. So I was in Las Vegas it was my first time to Las Vegas, just with a friend, and I saw the glitz and the glamour there, and I was realizing that what I thought the opportunities were going to be in the IT industry weren't really there, and started thinking about something else. So I'd read Rich Dad, Poor Dad a few years before. My aunt had give that book to me. I think it was actually my high school graduation. I was gifted that book. And so I knew a little bit about real estate from that, but I bought one of those airport books at Hudson News, How to Make Money in Real Estate, No Money Down, and read it cover to cover on that flight back home after probably losing $80 at blackjack and being scared and realizing I needed to do something to build wealth. And fortunately, my college landlord became my first mentor. He was a real estate broker. He owned a bunch of properties, was renting to college kids and just other professionals in Rochester. And within a month, I bought a house, no money down. And within another few months, I bought another one. I actually left closing with money because it was an old FHA assumable loan where I actually left closing with $350 that they wrote a check back to me for at closing.
So they paid you to buy the property.
Yeah, absolutely. Those deals were real. And Rochester was not an expensive market. This is 2002, 2001. The real estate was really starting to take off in California and New York, but this was like it's, even though it's New York State, it's really more of a Midwestern Rust Belt type market. So within a year, I quit my job and got my real estate license. And I did all the traditional real estate. I did wholesaling, fix and flip. We managed, I had 50 of my own units, and we managed a few hundred units for others, and realized pretty early on that the difficulty of scaling, single family, 2-family properties, and, the thankless aspect of being a property manager. So really paid my dues early on and just went headfirst into the real estate business. Now, when 2008 happened, I'd wanted to relocate back down towards New York. I always wanted to live in the city, and had a unique opportunity. There was a number of private equity funds that were buying the non-performing mortgages, and they needed real estate people to work on the banking side. They needed people who had done short sales, who had bought foreclosures to help them understand their portfolios and make sure they weren't going to get taken advantage of by all the real estate sharks that are, buying at the courthouse steps. So I ended up moving to New York City in December of 2008, the heart of the financial crisis, and kind of dove headfirst into the market of buying non-performing mortgages. So it was a pretty crazy ride there as well. From 2008 until 2019, I was, on Wall Street, or, technically our office was in Midtown. We say Wall Street because it's banking, but in reality, a lot of the firms were in Midtown as opposed to downtown. And, we ended up, I left one firm, I partnered with a small family office. Then eventually we partnered with a large private equity fund, and we bought $3 billion worth of loans, and transacted with Goldman Sachs, Nomura, bought directly from Fannie Mae, Freddie Mac, and we bought over 30,000 loans during that period of time. Was a really crazy ride. But as someone who's been an entrepreneur and really approached real estate as part of improving my lifestyle and building wealth, it became too much of a Wall Street grind and not enough of a lifestyle for me. So eventually I was looking for something that I could reclaim my time and really accomplish what I sought out to when I got into real estate investing, was to have that work-life balance, build wealth, enjoy life. So eventually I left as an employee, and I had a few other people I knew who moved down to Puerto Rico. And there's some interesting tax benefits for living in Puerto Rico. On top of, I live a block from the beach. It's almost always in the 80s, never gets too cold, never really gets above 90, just because of the winds off of the ocean. So it's a great place to live. And there's thousands of us who've made the move in recent years. So there's a great community. And eventually was able to be bought out as well, and worked out very efficiently. And I'd been investing in real estate since my early 20s. I had done some syndication investing while I lived in New York, because I knew how difficult it was to manage individual properties yourself. And I was busy, and I didn't want to create myself another second job.
Right.
So I'd already been investing in syndications. And once I, had a pile of money myself, I had to figure out what to do next. And, I decided to build a business around investing in syndications. I had a lot of my own money to invest. And for years, I had investors that wanted to invest, with me, but we weren't allowed to take their money because, we had pension fund money and this large, New York money. So I was excited to be able to start a fund and give access to people that I knew, access to these investments, which I think are far superior to, to what's available, in the stock market and in index funds.
Absolutely. And, what we aim to do at Lone Star Capital, of course, and what you're aiming to do with JKAM and, the various investments you've been in, is obviously to be in outperform the market beta, which is, whatever the S&P 500 would be, or just normal market rate returns, which is historically, call it between 5 to, 9%. Some say 8%, historically speaking. That's really good. But call it just around that 6-7% to outperform that. And, naturally, a lot of deals that we do together, that's what the cash on cash looks like, regardless of, net of, whatever the other expenses associated with the deal might be, and also the tax benefits that we get here. Let's take it back, though, to the 2008 time period. So you explained to me that you got the job with the group kind of through a funny back channel. Can you tell that story?
Yeah, so I was actually on Craigslist of all places. And, this was still, 2008. Craigslist is, still around, but I mean, that was probably the peak of Craigslist. But most of the time you're either looking for a couch, a roommate, or something illicit. And, I found a Wall Street job on there. So yeah, this was the firm I worked for was, it was a small shop. I think there might've been 15 to 20 people. So it was really a new industry. It's not that there weren't non-performing loans prior, but when you had hundreds of thousands or probably millions of non-performing loans, there wasn't really a mature industry set up. There's a few guys here or there that would buy some loans, but really an industry was really built around modifying that paper. So and they needed people. So they were looking for guys like me, I guess, that were kind of we were using Craigslist to advertise to buy property and that type of stuff too. So right. They weren't gonna they didn't need Ivy League people. They needed people that were hustlers. So
right,
I guess it was smarter than to put it on there.
Yeah, and that's a really cool, unique story. And were you buying, basically, to our understanding, the audience understanding, is basically mortgages that were maybe in default, or what were you basically buying, and what was the ultimate goal of the acquisition of the mortgage? Basically, to buy it, to restructure it, and then sell it later. Were you buying CDOs? What were you basically acquiring? Can you kind of walk through that? Because I do think it's interesting, because I think right now what we're going through is a commercial consolidation of debt issues. The residential space, considering how historically low they got and the 30-year debt nature of it, is interesting, because it makes the residential market so much more stable. But naturally, right now in the commercial market, what are we seeing? We're seeing a lot of issues with trillions of dollars in maturities. Office is going to get hit likely the hardest. if you've got multifamily deals that have bridge or floating rate debt that were bought in 2021 or 2020 or 2022, you're, likely looking at maturity options and whatnot. So we can kind of dive into that, but kind of interesting how, the 2008 crisis, which you went through, was mortgages. So was that in fact what you were doing? Walk through kind of the game and how, folks like yourself got to make money in that kind of sector and that era.
Sure. So, first things first, we were buying the individual whole loans. So we became the bank. We would buy from, as we grew, we eventually bought directly from Fannie Mae. And, what was happening is the larger banks and the larger servicers, they just weren't as efficient. They didn't have the staffing or the manpower. And sometimes they just had a bureaucracy or the lack of process for doing modifications where they would deny someone because they sent one pay stub and not two pay stub, but the guy makes 100,000 a year. But for whatever reason, there was like just a minutia of paperwork that was causing them not to get things done. So, we would take over and become the bank. And we really were just looking for the best overall outcome. And especially if there was a win-win, we were never looking purposely to foreclose, but unfortunately, a lot of people got loans in 2006 that probably should have never gotten a loan to begin with. They couldn't afford it. So if someone just flat out could not afford the property, eventually we would have to foreclose. But overall, we actually made more money by doing modifications. Some of our best deals, we would buy the loan, the bank that sold it would take the big hit, and we would be buying it at a pretty substantial discount. So we had a lot of room to work with the borrower to either lower their payment, to forgive some of the balance, to take some of their past due and put it on the end of the loan. And during that time, during the recession, we found a lot of people were, had maybe lost their job for 6 months to a year just because of the recession. And now they had a new job and they could make their payment, but they couldn't put down $20,000 to reinstate all at once. So, we were flexible when we could be. There were people who made strategic defaults, especially, in 2009, 10, 11, when values were cratering. So in those cases, if we bought the loan cheap enough and we knew what the property was worth now, we might set up a payment plan and give that borrower an option to pay us for 1 or 2 years on time, and then when they were to sell or refinance, we would reduce the balance to a point where they can not be underwater for the rest of their lives.
Right.
So we did a lot of good. Everyone, people would always think we were vultures, but, I think overall we helped anyone who had the ability to be helped. We were there and we were flexible to help them. And I think we did a lot of good, and we were a lot more efficient than some of the big banks would be. To your other point, I completely agree. This industry still exists, but, the volume of foreclosures is way down. The amount of equity we have now is far different. In 2008, that most people were in these option arm loans that were actually going up in interest rate, whereas now I believe about 70% of the population is locked below 4%, and between 30 and 40% of homeowners actually don't have a mortgage at all. There's so many baby boomers who have houses free and clear right now, and there's just not going to be the same level of inventory. So that bodes well for multifamily in general. You alluded to a lot of the issues with those that have floating rate debt, and those are certainly issues. But overall, it's a lower percentage of the overall market. There's still a lot of family offices and pension fund. There's groups that own multifamily buildings that just went into 10-year debt that never touched a bridge loan. I think I heard Neil Bawa talk on one of the presentations. He pulled some data that it's really less than 10% of multifamily debt is floating rate. So while we both know people who are in that space and have some challenges, I think overall it's not enough to be any sort of contagion that's going to drastically hurt the multifamily market or drastically drop prices.
Yeah, I think we are seeing a discount and a resetting right now as we speak, but these gaps and windows open and close very quickly, to your point. And then back on the residential side and the loan space there, were you guys essentially individually underwriting each opportunity to see if there was an opportunity on your end or for each deal, if it made sense to kind of manage and do a workout? What would that kind of look like on your end? And would you specifically kind of go through some comparable sets? Would you basically work through with that individual, the borrower? And, can you kind of talk about what that looked like?
Sure. So, there was no borrower contact before the purchase. So we were somewhat flying blind, and, the level of diligence depended on how big a portfolio would be. If we were looking at 5 loans, we'd be diving into the valuations on each loan, doing as much research as possible. Looking through all the history, the servicing notes, we would see what the banks, had discussed if there was, an active conversation about a modification. As we grew and we were buying 1,000 loans at a time, I mean, the underwriting model was robust and not too dissimilar than a multifamily. You're running different scenarios. You're looking at, okay, well, if the rent growth is X, half the units will be renovated. They're going to go up in rent this much. We were doing that similarly on these models where, these loans have equity. They're probably going to modify this percentage of the time, and then this percentage of the time they foreclose. If it forecloses, here's our foreclosure costs and our timeline. And we would just make our best efforts to kind of figure out what scenario was most likely and model it accordingly. And overall, we did we were pretty spot on, and over time we got better and better at predicting which loans would be performing and which loans would not perform. Within a pretty solid, within a couple percentage points on a large portfolio.
Right. So what from that experience and your knowledge of, several market cycles, because I think you mentioned maybe in 2001 is when you're coming out, or that was maybe around your college tenure, you maybe graduated around then, but you kind of probably felt that, dot-com bubble boom, depending upon what you were doing at that time. You obviously had a very, very front row seat to the '08 crisis. And then now we're potentially heading into a recession currently. What similarities do you see or maybe, patterns are you recognizing right now as we're likely heading into a recession? And, what are kind of some of the tweaks that you're making on your end with your business to help mitigate that as a capital raiser?
Yeah. So, I mean, the interest rates going up is certainly that happened in '05, '06, '07 as well. I mean, rates got to 6, 7, 8%. Interest rates going up are, a natural pressure on the economy. So, and they went up faster this time than they even did back then. And the economy has been a lot more resilient than it was during that time as well. So, we're keeping a very close eye on interest rates and specifically the 5 and the 10 year. Whereas we'd mentioned the bridge loans that were tied to the short term, the SOFR, what used to be the LIBOR rate. But ultimately, the 5 and the 10 year, moved up dramatically a few months ago, but then they've come back down. The 10 year as we record this today is like 4.117%. So, that fortunately did not move as dramatically as, as the Fed increasing the Fed's funds rate. So, that gives me some optimism that, the market's sort of pricing in where, that rates will come back down to earth and that we're probably towards the end of the cycle. The 2001 and the 2008 just kind of showed me that, the music can stop at some point. There's no guarantee of sustained growth. There's, I learned this in business school. There's no such thing as a sustained competitive advantage. The markets will adapt, people will adapt. Something that's working today may not work in 5 years. So you just need to be able to pivot, when it makes sense. And we crushed it early on in our first fund on, some of the value add deals that doubled our money in a year. And fortunately, we're in a fair amount of deals with fixed rate debt. We do have some bridge debt exposure, but we had a number of deals that were 10-year debt to begin with. I know our deals with you all refinanced into long-term fixed rate debt now. So really just thinking a lot more about, capital preservation and really getting back to the basics. Deals that are cash flow positive day one, deals that if the deal pencils out with the higher interest rates now, there's a lot more upside, if rates do kind of come back down a point or so over the next couple of years. So it's really back to the basics and just focusing on just protecting our investor capital, protecting my own capital, which I'm, the largest individual investor in my funds. So.
Right. And, with downside protection too, that's kind of the name of the game you just mentioned. So, the music is stopping, as you mentioned. Rates are, hopefully at the high, which means the cycle is going to end and then restart. How long do you think it's going to take for everything to be digested this time around? Obviously things are always varying and whatnot. And, to your point, the market is a lot more robust now. There is a lot more, jobs, and a lot more growth and opportunity in the marketplace today than there was in 2008 and 9, which would help kind of rebound things. And recessions hopefully will be a little bit, quicker, you're in one and you're out of them, ideally in a shorter time span. But what on that end is kind of concerning you?
Yeah, I mean, I'm overall pretty optimistic, actually. So I don't know that it's a major concern. There's a great book by Howard Marks, who was the founder of Oak Tree Capital, who is really, he's been early on a few cycles, but they were one of the early funds buying non-performing loans in 2008. And he says repeatedly that history may not repeat itself, but it does rhyme.
Yes.
So I look through these prior cycles, but there's a few things that are drastically different this time. There's an inherent labor shortage that hasn't really been around for the last 20, 30 years. The baby boomers are the largest generation, and on average, they've all retired at this point. So, Generation X, which I'm right on the border of, myself was a much smaller generation, and you have the millennials coming up, which are, generally the children of baby boomers. So it certainly wasn't as big as the baby boomer generation, but they're sort of coming of age right now. But there's a drastic labor shortage. So even though rates are up and the Fed is trying to kind of slow the economy, unemployment's not really ticking up, and it would they would have had to raise rates probably significantly higher to cause a major recession that really pushed unemployment up to those peaks, just because there's overall just a major job shortage. So that's the first thing that's different this time around than other times around. And then, secondly, is that lack of supply. Now that's market dependent. There are some markets where there's, a fair amount of new construction coming on board, but where I focused a lot on, and I know, a lot of the, the portfolio that we're invested in together, are properties that we're buying below replacement cost, where they're just not able to build. You can't build a Class B apartment building for what it costs to build right now. And you have high material costs, high construction costs, high interest rates, lack of labor to even find the right, which causes construction costs to be higher. So,
right.
There's a few of these mitigating factors that overall make me very bullish on the economy itself. And that, my thought is that, in 1 to 2 years, at most, we're in a new normal, and there's nothing wrong with interest rates being at, if the 10 years at 4 and interest rates are 5.5%. I mean, that's a healthy market. If anything, there was something unhealthy about, rates being at 0, and it's really what caused that, and just the flood of money from COVID, which was really hopefully a once in a century type of thing.
Yeah. Well, and that's the thing too.
Or never again.
Yeah, well, I have so many things, so many items to unpack there, right? Number one is rates should have, in my opinion, never have gotten that low. And because of that, we have the whiplash effect, and people got too high in drunken interest rates, which caused valuations to get crazy. Naturally, we're seeing that right now as the workouts. Not that these properties aren't performing well or occupancy isn't good. It's that, oh yeah, well, you bought a property here with cap rates here, and then it raises up naturally. When rates go up, well, the math isn't really in your favor there. And that's kind of the challenge that we're working through currently. Replacement costs, you had hit it so well. And, at Lone Star, this is something that we really look for is, hey, how much supply is coming up in the immediate vicinity, right? We try to avoid, frankly, downtown areas because you are competing with new supply all the time, but we want to be in that more, garden style asset, which is more suburban. Suburban areas are built out, and, you're not going to build new units there. So there's a nice moat around that for sure. And as you are, and we're all kind of moving forward together in the shifting market, what are you looking for in a real estate investment currently? What are kind of some of the metrics that would make you feel comfortable as a capital allocator, and obviously a huge, investor yourself, as you're putting your personal capital into your funds? What are you seeking for deals right now on a downside protection risk and then an upside scenario?
Yeah, well, certainly by nature, the deals right now have lower loan to values. So less debt. That's required to make the deals pencil with with where current interest rates are. So overall, we're just being a little more conservative. And if a deal pencils now, and if it's generating positive cash flow and a cash on cash return with these rates, I think there's significant upside. So we like that there's more conservative overall underwriting and a more conservative loan to value and capital stack. Some type of value add. Now on multifamily, it's largely renovating apartments, managing it more efficiently if you're buying from a mom and pop operator. But we want everything we look at is we're looking for some type of value add. We're not necessarily in the business of, doing a triple net lease Walgreens where you just sort of you're buying an income stream. So, for multifamily, it's that. For self-storage, mobile home parks, for self-storage, it's making climate control units, maybe building another set of units if you have extra land. Mobile home parks, it can be infilling a lot. We're invested in a marina deal where covered marina spots are very sought after now, whereas 20 years ago there was more about having a sailboat. So you could buy, the one group we work with buys marinas and just basically puts covers on them so that people can use their power boats, and they want to have some shade. They want to be able to plug in and charge their electronics, maybe watch a college football game for a few hours, then go out on the lake for a few hours. So there's a value add across whatever we do. And we just look for whatever that value add is for the asset class, so that if the business plan is executed, regardless of what happens in the economy, regardless of if rates are up 1% or down 1%, we want to know that there's some forced appreciation through the business plan, because if you have control over that, and if you execute on the business plan, you're 90% there. That's what you can control. You cannot control interest rates. You cannot control inflation. But if you can control that, and you're confident with the team that you're partnering with, that they could execute on that part, you're a long way towards a success.
Yeah, I know. It's all about, kind of controlling what you can control, fixing what you can fix. You can, work with good operators and partner with that. Okay, that's in your control. And then working with the group who you have an aligned interest with and belief and philosophy with which is structuring the debt and equity to make sure that is sorted out, that regardless of, the market kind of going crazy, you can create a moat around that naturally. So it's super, super important to have that there. And then, of course, forcing appreciation of value, capturing upside, and kind of creating above market returns is how we do achieve that with the value add enhancement plan, which you just alluded and broke out perfectly, which is nice. Another question on that kind of similar topic is, how do you vet a sponsor and someone to work with? You've obviously, been in Manhattan for a while. Now you're in out of, I guess you're in a province, I should say. How do you kind of vet sponsors? What does that look like for you? I'm sure you get pitched all the time, considering you're a fund manager. It's kind of like being the pretty girl at the party. Everyone wants your money, right? So can you kind of walk us through your steps with, when you say yes to someone?
Yeah, and then look, there's an art and a science to that, and our initial deals were generally with people that I met years ago, that I just met organically through just being in the real estate industry, going to conferences. My first deal was with someone that I had a very similar background to me, that had I knew from the one of the real estate investment clubs in New York, and he'd bought single families, kind of burnt out, realized it wasn't scalable, and started moving upstream, and was buying 100 to 200 unit buildings in the Southeast. So, my first syndication investment years ago when I was still in New York was with him, and that was just an organic relationship. But I knew other investors that he had worked with. There isn't a scenario we've had so far where we're just investing with someone who's a cold outreach off of our website. It's through personal relationships I've had for a number of years, through direct referrals. We have investors that, I'm sure we share a few investors, but there's investors that invest in our fund for diversification that also have invested in some direct deals. And if one of my current investors has had success elsewhere, that's important. And, I'm in a lot of industry trade show events. We've, Craig, we got to know each other. I knew Rob first, but we got to know each other across these conferences where, you're meeting a number of operators and investors all together. And, there's no substitute for that, just getting to know someone, one-on-one, having that social proof of other, referrals of people that have worked together, and, getting to, spend time to get to know them one-on-one. And then there's the standard of, just making sure they don't have a criminal record, and, the basic stuff. But it's really just getting to know them, track record, referrals, seeing some sample reporting. Will you get your K1s in on time? We do have a group or two that's on our shit list for being late with the K1s.
Not us, of course.
Swear.
Yeah.
I don't know if that you could. I'm sure you could bleep that if you need to.
No, we'll let you let it fly. We'll give you the green light. Good stuff. Yeah, and those are. I'm always fascinated to hear what you say yes to, because of course, everyone's got a deal, but the equity is the hard part to solve for, of course. And since we don't have a limited pools of pocket, we can't invest everywhere. And I'm sure you get great options at all times. And I'm sure you're getting pitched deals, on the daily to you. So, what you say yes to is, really important, but, what you say no to is even more important, right? And,
Yeah.
hopefully avoiding opportunities where, you see the pitfalls from, maybe other experiences, or, maybe others have, said something that kind of guided you in the right direction, perhaps.
Yeah, yeah, and there's an art and a science there too. And we run two different funds. We have our diversified fund where concentration risks do come into play. Where even if we love a deal, we can't have the fund to be 100% Houston, as an example, and nor do we want it to be 100% multifamily. So, there's a little bit of concentration risk on that type of fund, but. As far as things that we say yes to versus not say yes to, a multifamily value add deal can be, a lot of them have mid upper teens returns. The playbook is pretty standard. So, we've got a number of groups we've got a successful track record with already, you included. So, if someone's off the street or at a not off the street, but at a conference, and it's just a standard mid teens deal with a couple $100 value add plan, those deals, we see a fair amount of those, and we have groups that we've done them a number of times successfully with. So that doesn't necessarily get my attention. There's got to be what's the hook? What's different about that deal than others? So like over the last year, assumable debt might get my attention.
Right.
There was a deal that unfortunately the insurance costs ended up killing the deal, but there was an assumption of a 2.88% HUD loan. That got my attention. What you guys do with the partnership program where it reduces the property taxes dramatically, that gets my attention. It's something different. It's a unique value add. So those things get my attention. On other asset classes, I'd mentioned the marina deals. Those are 12 cap entries as opposed to multifamily is a 5.5, maybe 6 at best entry. So
right.
An asset class that's a little off the beaten path that certainly, took a little time to get comfortable with, but it's not too different than self-storage or RV parks. It's a mom and pop owned industry that, with the right operator you're confident in, has a lot higher current cash flow. So, those things get our attention. High depreciation. If there's something that has an above average tax loss, we're in. I don't know if this airs before the end of the year, but year-end depreciation is a big thing for many investors, including myself, to avoid paying tax to the government if possible, if at all possible, in a legal way.
Yeah, and that actually segues perfectly into my next question, which is, what type of deals do you raise for? And I would say typically is what I would ask, but there's no typical with how wide and vast you might go in reference to opportunities. I know you've done oil and gas deals before, and then you've got these marina deals, self-storage, multifamily, but ideally, what do you like to raise for? And maybe just walk us through kind of some of the unique deals that your fund is in and what you like to invest in as well.
Sure. So, the funds are largely real estate based. So, the oil and gas is something that I've sort of done as a value add for some of my investors that have high W-2 or active income, because there's only so much real estate can do. A bulk, I'd say at least half of what we're generally focused on is that multifamily value add. I mean, that's a core asset class, and I expect that to continue to be a core asset class for a long time to come. So, that's the pretty standard playbook. Rounding that out, we do like self-storage. We do like mobile home park. The marinas was kind of unique, and it kind of just right time, right place, right relationship fell into our lap. And it's not too different. The value add is doing some level of renovation to make it more attractive, whether that's covering the docks, whether that's adding some RV park spots. There's actually a few houseboats at one of them where it's basically an Airbnb or a VRBO model, but they have a houseboat where you can, live on the lake for a few days. And then, just oil and gas is great. It's another, still a cash flowing focus, but, kind of adjacent to real estate, but not exactly real estate. And then personally, I'm in a few venture deals. I don't feel like I have enough capital to be diversified enough to be an angel investor in startups, but I've done a few with people I knew through business school, and I'm invested in a few funds that have that diversification. So, but a bulk of my net worth is in real estate and will continue to be, because it's to me the absolute best asset class. And I do think that, part of my mission is there's way too many accredited investors, especially those worth that 1 to 10 million or so, that have a great majority of their wealth just tied up in the standard stock market index funds. And that industry there's so many levels of that industry of people getting paid that unfortunately I think the people's returns will suffer because of that. People that have money into annuities or things spitting off 3% a year, frankly lower than treasuries right now. So part of my mission is to just get the word out there on these other options in the alternative investment space that it's really been about 10 years that we've been allowed to advertise. Before 2012, these were country club deals. You had to know someone from your country club because you weren't allowed to advertise. But the word is getting out now, and it's still relatively new. So I think it's really important that more people get aware of these types of opportunities, which do generally beat the stock market, and it makes sense that they do as well. If you think about, if you're going to spend millions of dollars to go public, you're spending that money because it can lower your cost of capital. So that's why the average REIT might only pay a 4 or 5% dividend, whereas a good syndication is if things go reasonably to pro forma, should generate a 15 to 20% average annual return or IRR, and with a current cash flow very close or even exceeding what a typical dividend might be on a REIT, and the tax benefits are better.
Absolutely. Well, it's funny. We're seeing yields on our end, which should get everyone excited, you included, for these opportunities coming up, where the cash on cash is going to knock out our preferred return status on these deals. We're talking about deals that are stabilizing to 9.5, 10% almost, where it's like, shoot, does it even make sense to take that, or should we just distribute that back into the property after 8%? To maybe enhance CapEx, something like that could boost the exit value of the property, because we're hitting that return so easily on the cash flows, which is great, because now yields are up, which is awesome. It took all of the year to accomplish that, and kind of the changing landscape of the market, which is great. With that said, what's making you nervous about what's coming up, currently, maybe with your exposure or just generally in the market? Or, you did mention that you are optimistic, but is there anything that you're, kind of struggling with, or makes you slightly weary or uncomfortable?
Yeah, I mean, look, we have we have one capital call we're making right now. We're in close to 50 deals overall, but our first fund that was, kind of towards the end of its deployment was deploying in 2021, when just a lot of the deals were bridge debt, and there was a good reason for some of the bridge debt. Also, there was no prepayment penalty. So when the market was doing what it was doing, you wanted to be able to sell in 1 year, and we successfully doubled our money on a deal in a year and a day. Would have sold earlier, but we had to wait 1 year for tax purposes. So certainly we're making, we've had one capital call. We may have a few others. We also have a lot of deals. A bulk of our portfolio is actually kind of past the point where I would be nervous. A number of deals modified, and that goes to investing with the right partners. There's a saying where if you owe the bank $1 million, you're screwed. But if you owe the bank $1 billion, they're screwed.
Yeah. I thought you used a little more colorful language. You know what? I know you so well.
I cleaned it up a little
bit. Yes.
Yeah.
So can you maybe also just dive in and talk about that and break it down for the audience who may not be aware exactly what it looks like? And this is exactly why I wanted you to have to be on the show, because you can speak to this so well with your institutional experience, with your your New York, Manhattan kind of background. Explain why that is. Explain why, once more, this quote, which is, if you owe the bank $1 million, you're not in a good situation. If the bank, or you owe the bank $1 billion, they're not well off. So explain why that is, and the nuance regarding that.
Sure. So if you're just like a nobody and you have one property, it's not going to move the bank's balance sheet if they foreclose or not. Like, you're just not going to have their attention. But one of the groups that we're in 4 different deals with, they had over $1 billion of exposure with one lender, and that lender has already modified all of their loans, because if they did not work with them, it would cause a major issue on their balance sheet. Some of their loans may have been tied with like mortgage-backed securities, so it could actually cause the bank to default as well. And, and an operator who's doing a good job overall, but is just kind of caught up in this interest rate move, they don't feel that they're going to manage the property any better than the current operator. So they're better off working together and giving them the time and the interest rate relief to finish their business plan, increase the rents, and eventually successfully pay them off. As opposed to maybe pushing them over the edge and creating themselves larger problems. So we've seen that very successfully on, in one of our deals, there is a capital call, but it's actually as part of the modification. So the bank's agreeing to lower the interest rate for the next 2 years. They're tacking on some of it to the end of the loan. But, for the next 2 years, there's interest rate relief. But, for that, the bank wanted to confirm that the property was properly capitalized. So we're putting some more money, essentially into the property's operating account. But because, with that, we know we're set for the next 2 years. We know we have the money to finish renovations as needed. And, it's a partnership, and it's, what should be a win-win with that bank that, not every operator would have been able to do that. We've had other operators that the banks were not cooperating with construction draws that, had, well over $1 million of their own money into renovating units just to make sure the project kept moving along and didn't stall out.
Interesting. And I have a couple of thoughts here. So, and we've talked about this before on the Capital Spotlight podcast, and this is very well noted that Tides, for instance, got the workout. They have so many properties that, that would be a very, very bad downstream effect should that happen. But if you're an operator who's got maybe 5 properties total, all spread out the nation, well, those are probably the first people that will get plucked and the first opportunities that will get plucked. That's where the bank will come in and probably not be as friendly, right? So that's something to think about. And, it goes to another thing that you said, which is if you're going to meet the capital call, make sure the capital call is met to, not make a couple loan payments, because that sounds like you're going to lose your money twice. But, do it where you're going to get secured with, a couple years to live to fight another day, to, go to 2025 or 2026 with your capital call, or maybe you get in a longer fixed rate situation. If you want to do that, that's fine. But those are the opportunities in the situations where a capital call would be met. 2 final parts. Number one is the first one is, to this point, we talked about what's getting you concerned. What's getting you excited as we're kind of restarting the market cycle and process?
So, a couple of things. Number one is just that, we're a couple of years in. I've been in real estate for 20 years, but, we've really only opened up, in 2020. So, we're getting closer to going full cycle, and, a couple of years of just getting the word out there. And I've seen that momentum build, doing things like this, getting the word out there, really just helping get more people aware of these opportunities. So I'm excited that the little tribe that's been built over the last few years of people that I've personally, I've got a lot of people into real estate in my 20s. I got a lot of people into buying non-performing loans in my 30s. And, now in my 40s, a lot of my friends and colleagues have built a little bit of wealth and are trying to start, thinking towards either retirement or, at least building a portfolio towards retirement, and or are paying way too much in taxes. So I'm really enjoying being an evangelist and helping, point people in the right direction and guide people to better alternatives. So that excites me, just overall in big picture. And then secondly, you alluded to, the stabilized yields in the 8s or 9s, the fact that, this is the real estate market I started in 2001, 2002. That wasn't, and then all of a sudden by 06, 07, it got a little crazy, at least on the residential side. And then I went through the downside, and, there's a market that's, stable and normal, has opportunities, but is not so frothy that, you're competing with 30 people to buy a deal, and that people are dumb and overpaying. I think a lot of those people are kind of out of the market for a while, are probably going to get flushed out. And, those that are still, competing and have capital are the sophisticated and experienced operators that knew better.
Absolutely. No, that's awesome. And final part is you touched on it before. You live in Puerto Rico, correct?
Yes, I do.
Can you kind of give us just the story? And this is, I know you're kind of coming close here on time to end, but could you maybe just tell the reason why you're in Puerto Rico? You had a big pop, it sounded like, if you want to touch into that, from the mortgage space. So you had that, and you kind of said, hey, Puerto Rico makes sense because, you get these pops. Ideally, we get them again. But, if this is your last pop, or maybe the biggest one you're going to get, we might as well be as lean and as efficient as possible with it. So can you kind of break down your logic, the lifestyle play associated with it, and maybe all components regarding the move out there?
Sure. So, everyone's situation is a bit different, so it's not official tax advice, but the high level of Puerto Rico itself is they have an Export Services Act where there's only a 4% tax rate on export services. So if you live in Puerto Rico and you're a bona fide resident, but you make money from the US and bring it into Puerto Rico, it's only taxed at 4%. So there's a number of, hedge funds, private equity funds, consulting firms, internet marketing. If you do anything, that's not forcing you to be in a brick and mortar office in the States or doing work, in a client's office, it's something that may be available to you in Puerto Rico. The second part of it is there's no short-term or long-term capital gains on Puerto Rico sourced income, which is stocks, cryptocurrency, options, essentially everything but real estate. Real estate is unfortunately still taxed where the properties are, but real estate has so many tax benefits anyway that living down here and having no other, I have no active income. I don't have a W-2. I don't have anything in the States that would be considered active. So all of my real estate and rental income is passive, and it shows a loss because of depreciation. So the combination of those tax benefits is very powerful. On the lifestyle side, I was very burnt out in New York. I love New York. It's a great place for me to have a pied a terre at some point in the future. But it was, I was burnt out, and I live a block from the beach. There's thousands of other like-minded business owners who've moved here in recent years. So, any given night of the week, I could be, out for, steak dinner or happy hour with, 5 or 6 multimillionaires that all have their own story. All also, had success in life, but also that sense of adventure to actually move here. So that's what's keeping me here is the network. It's like joining a country club, but not having to, instead of paying a 6-figure entry fee, you're, getting a 6 or 7-figure tax savings. So, it's been great. And look, we're helping an island that, had a major hurricane in 2017, had a population decline over, kind of a 20-year recession. So, having us come to the island, hire people, even without employees themselves, spend a lot of money. I bought a car, accountants, attorneys, real estate agents. I think the contribution to the economy is really hard to put an exact dollar amount on, because it's not just about the employees, it's about the spending. And I think it's been great, and we're largely welcome here. There's a small minority of of those, just like there is in the States, that right, just think these rich people are moving here and not but I think when you look at the overall economic impact, it's been very powerful, and I've made a lot of new friends down here.
Can you also talk about maybe, and we'll wrap up with this, just kind of maybe the potential recapture, or for someone who maybe has a big stock pop, or maybe the IPO and they're about to get a lot of money coming their way, kind of what the mechanics look like with regards to sheltering that, money to make sure that you're most lean as possible. Maybe how long you have to be there on the front end, and then how long you have to stay there to make sure you don't have to, let's say if you move back to the great states we like to live in, but maybe not invest in, like a New York or a California. What's the kind of cycle like?
Sure. So, look, there's not a magic bullet. If you're like a week from an IPO, it's probably way too late. But if you know over a few years you're planning on a major exit, I think it's definitely an option, especially if it's one of those types of businesses that has a fair amount of intellectual property and a fair amount of revenue that's coming in, kind of online or without, physically doing work in someone's place. You do generally need to live here. In addition to being here half the year, there's the presence test, but there's also the closer connection test. So, a lot of people say, well, what if I do this? What if I get on a plane 3 days a week? If your wife, your kids, and your dog are somewhere else, and you're just coming down here 4 days a week just to say you set foot on the property, that's generally not going to work. It's a commitment. You need to, if you're going to do anything down here, you need to be committed to, you're going to move here. You're going to, make the island your home, and please make the most of it, because it's great. And there's great people, both the locals, and there's a pretty cool community of us entrepreneurs who moved here. So yeah, there's a number of good resources. There's a group called PR Relocate that is actually, kind of a government sponsors them to help promote the program, so they can give a lot of information, at a high level for free. If it's a large exit, there's a number of great attorneys, accountants. Once you're into the, 7-figure plus exits, you just got to pay for the proper legal advice and structure things the best you can. And once you're here, once that money is if you have the exit, or even just relocate your business here and are saving significant money, it's going to grow tax-free generally for the next 20 years through these decrees.
I love that. Final question. I lied. This is the final one. What's your hottest real estate take?
So I guess it's advice, because I've been through it, for people, is that be very careful of trying to do something small on your own that's going to just create you a job you hate. If you're an accredited investor, you've got a few $1 million in the bank, and you think, oh, I'm just the guy who does it better myself, I'm not going to put money into something passively, I'm going to go buy myself an Airbnb. Don't underestimate the amount of time and hours that it's going to take. Even though I live in Puerto Rico, and I know a bunch of people that have more money than me that are like schlepping around, cleaning Airbnb units because their cleaner didn't show up today, somebody moving in. Just don't underestimate the amount of work this business takes. And these syndications, obviously, our goals are to make a percentage of profits and make everyone money, and obviously make some money ourselves. But don't forget the amount of time and effort it takes to do this business. And I guess the other component of that is it's not like you just randomly write checks. It's passive investing, but I'd say it's active passive investing. So get out, listen to shows like this, go to conferences, meet people face to face. The work on passive investing is done up front. And that's what we do on behalf of our investors. And I encourage them to do that, for us, and come meet us as well. But, we're on the road, going to conferences, visiting properties, and doing all that analysis so that our investors don't have to. But, just you got to choose your battles, and buying an individual property yourself is not that one. I used to say no tenants and no toilets when I got into the mortgage business. I've added no tourists, because I'm not going to be the one that deals with an angry phone call from someone because I forgot to fill their soap dish on an Airbnb.
Yeah, I love that. Jack, thank you so much for coming on the show. Where can people find you and best reach out to you if they want to learn more about you, connect with you, maybe invest with you? Can you kind of walk through all those channels for us, please?
Sure, absolutely. So our website is JKAM Investments. That's JKAM for JK Asset Management, jkaminvestments.com. We're also on all social media. I've both my personal page and company. So connect with me personally on Facebook, on LinkedIn, on Instagram. I'm Jack Krupey on Instagram, and we even have a TikTok account. I don't manage that one myself. I don't have a dance move or anything, but we're on all the major platforms, and we have a podcast called the Alternative Investor Mastermind, which is on iTunes, Spotify. Craig, I'd love to have you on our show at some point as well.
Perfect. Love it. Thank you so much. Will I see you in Phoenix, Arizona for Raise Fest in February?
I am pretty sure I'll be there. I still have to make my travel plans, but I try not to miss that one.
Yeah. Well, Jack is one of the most funny people you could ever meet in your life. Great guy, awesome partner. So thank you so much for coming on the show, and also a world traveler. So hopefully you'll make some time to visit me and my home in Phoenix, and obviously get around us and Rob, and we'll discuss the newest and latest and greatest deals. Fun Friday. Thank you. Episode 6, Jack Krupey. We're out. Take care.